Lori Calvasina is with us here at Post 9, obviously talking about the markets, head of U.S. equity strategy over at RBC Capital Markets, and Jurrien Timmer, Fidelity Investments Director of Global Macro. Happy Monday to both of you. Thanks for the time.
Thanks for having me.
How much of this changes your view, if at all?
So we actually, at the end of April, we put something out saying we think markets were ripe for a period of consolidation well before these trade jitters came on anyone's radar. I was frankly surprised that this was the negative catalyst, but we had been looking for a period of volatility to pick up.
Do you have a particular playbook here as we are caught in a game of chicken?
So short term, if you're thinking tactically and want to add a little defense to the portfolio, because I will say I think there's more downside here for the broad market, I would be tactically adding to utilities, very little in terms of trade war fears, valuations have gotten better. Consumer staples, now there is a little bit of trade issue there, but we like the sector. It's been hated, it hasn't been owned, it's got pricing power, and it's holding up pretty well over the past week.
Jurrien, do you agree?
Yes, I mean, excuse me, this was always going to be kind of a sell the news type of event because a resolution was completely priced in, and obviously now it has to be unpriced. You know, valuation is the ultimate and quickest transition mechanism for uncertainty, and obviously we now have a more uncertain future. We already had some uncertainty about earnings and when the kind of the V-shaped recovery in price was going to be matched by a recovery in earnings, and that's looking all right. And you know, the Fed was sort of on hold. I think the bond market is now putting the Fed back on notice that if this trade tension does not get resolved, that the Fed will need to step in and cut rates. You know, the market's looking for 2 cuts. But ultimately, it's about the V, the valuation. And at 17.1 times forward earnings a few weeks ago, the market was really pricing in a lot of good things to happen. And that valuation is now coming down. It's down about 10% or so, probably needs to come down more. I think the good news is that the market is really not as expensive as it looks if you look at sort of the free cash flow side of the argument. You know, on a PE basis, the market's at the 85th percentile of valuation going back to 1900. But on a total yield basis, dividends and buybacks, it's only at the 28th percentile. So that does give me some comfort that the market is okay, but probably valuations will need to come down until this is resolved.
Technicians, of course, have been at work over the last couple of weekends. Remember that we had trouble popping above 28.20?
Yeah.
Took 3 times. We finally did it. Now we're back to that level. Is there any reason to think it's magic somehow in terms of support?
I don't think it's necessarily magic. And, you know, we actually have looked at what happened in the rebound trades of 2010, 2011, and 2016. This kind of up and to the right move we've had since December 24th has been very unusual into that context. If you go back to those prior rebound trades, 4 to 10% pullbacks were actually very common, happened 2 to 3 times in each of those.
And we've only gotten 3.
Right, and we ran the math, and we could easily see this market just doing what we did back then. You could easily go to 27.50. You could easily go down to 26.50.